Think about this for a second. What if the simple geopolitical act of freezing hundreds of billions of dollars in foreign assets is actually the real story of the decade? What if it's fundamentally shifting how the entire world views the sanctity of the US dollar?
It's really not hyperbole. I mean, it's an observable fact at this point. Today, we're diving into source material that tracks a true flashpoint where, high-stakes geopolitics meets global finance. And the repercussions of this one decision are already creating tangible effects in central banks, from Beijing all the way to Brasilia.
Welcome to the deep dive. Our mission today is based on sources detailing a potentially imminent end to the Russia-Ukraine conflict, based on a very polarizing 28-point peace plan. But the real story, the real deep dive, is into the startling financial reaction across the globe. We're talking central banks, major commercial entities, particularly in Asia, and it's all in response to how those frozen Russian reserves are proposed to be used.
Right. There are basically three threads intertwined here that you really need to understand to get the full picture. First, you have the political framework for a peace deal. People are calling it Istanbul 2.0 or 3.0. Second, the controversial and frankly novel strategy for using those seized reserves. And this strategy basically confirms Moscow will never see that money again, not in cash, not in bonds. And third, the massive and accelerating global trend of de-dollarization, which is arguably the biggest long-term consequence. It's like opening Pandora's box with asset confiscation. And this isn't just theory, right? This isn't just about statecraft. This is about the foundational financial security and the counterparty risks surrounding every major currency holding in the world.
Right.
So let's unpack this. Okay, so to start, let's look at the deal framework itself. This 28-point plan, it's seen as a potential basis for resolution, but it is, as you said, deeply polarizing. Our sources indicate that for Ukraine's leadership and, frankly, much of the EU, the terms are just terrifying. Yet for the U.S., politically and financially, it's being pitched as the art of the deal.
And there's immense pressure here. We are seeing reports that the U.S. has delivered an ultimatum to Ukraine. Something like a deal needs to be reached by this Thursday, or key military support could be, significantly curtailed. That is just immense pressure. What are the core geopolitical concessions they're asking for?
The main one is pretty straightforward: banning NATO membership for Ukraine. But if you look at the political and financial clauses that secure this deal, they're genuinely fascinating. The sources describe the U.S. security guarantee part as almost godfather-ish.
Godfathers, that's a strong word. What does a godfather-ish guarantee even look like in international relations?
It means the U.S. offers security, but it gets compensated for that guarantee. We could be talking billions, maybe even hundreds of billions of dollars. It's a novel form of state-level protection, You pay the protector to ensure the threat, which is now contained, doesn't come back. And crucially, the plan also suggests Western sanctions would be lifted and Moscow would be invited to rejoin the G8.
That is a massive step towards reintegration, a huge win for Moscow.
It is, but there's a threat built in to act as a deterrent. If Russia invades again, all global sanctions snap back immediately, and any territorial recognition that might be part of the deal gets permanently revoked. That's the enforcement mechanism, so to speak.
But here is the critical economic contrast that I see. For the United States, their financial liability, all that money spent on aid, weapons, military intelligence, easily over $100 billion, is essentially written off. They get a security fee and they're, in effect, done.
While Europe is left with a far, far heavier consequence. Their economies are widely described in these sources as a smoldering ruin. The term mass deindustrialization comes up again and again because of the energy shocks and supply chain disruptions. So Europe has nothing tangible to show for it, and they're left with these long-term, painful financial consequences right on their doorstep, which puts them under a lot of pressure.
And that pressure brings us right to the centerpiece of this whole global financial controversy. How those frozen Russian reserves, maybe $300 billion, will actually be used. The sources all confirm one thing. Moscow is not getting that money back. Not in cash, not in bonds, period.
And that absolute certainty of confiscation, that's the root cause of the shift in behavior we're now seeing among central banks all over the world. The plan for these funds, it's split into three complex parts, and it really outlines a clear strategic U.S. agenda.
Okay, let's detail that. What's the first part of the strategy?
The first part is an initial fund of $100 billion, and it's to be invested in U.S.-led efforts to rebuild and invest in Ukraine.
U.S.-led, so we're talking American manpower, American tech, American companies.
Exactly. And here's the kicker. The U.S. will receive 50% of the profits from this massive venture.
50%. Wow, that profit split is incredibly revealing. It guarantees a long-term American financial interest in the region's redevelopment. But what about the other 50%? The sources are sketchy on that.
Very sketchy. It's not clear if that's for Russia, Europe, or Ukraine itself. That ambiguity suggests a serious point of friction down the line.
Okay, so that's part one. What's the second part?
The second part is Europe's contribution. They are expected to contribute another $100 billion to this fund.
But given the economic picture you just painted, that smoldering ruin, how is that even possible for them?
The sources describe it as extremely painful, maybe impossible, for Europe to finance without accessing those Russian reserves themselves, which is something they've been very hesitant to do for, legal reasons.
And the third part?
And the third part is the most telling about the long-term strategic interest here. The remainder of the frozen funds will be invested in a separate U.S.-Russian investment vehicle for joint projects.
Wait, hold on. You're saying that Russia's losing hundreds of billions, yet they're agreeing to cooperate on a joint investment vehicle with the U.S. That seems like a massive contradiction. Why would they ever agree to that?
It is contradictory, but it speaks to a deeper strategic calculation.
Yeah.
What are those joint projects? Well, this is likely targeting developing resource mines, securing rare earth supply chains, especially in territories captured by the Russians. By agreeing to this, Russia locks the U.S. into a long-term economic interest in the region.
I remember those wildly optimistic claims, something like $15 trillion in mineral riches. But even if it's a fraction of that, we know there are critical metals in those contested areas, and the U.S. needs those resources for its own tech competition.
Precisely. If Russia works with the U.S. to extract rare earths, it creates a powerful deterrent against future conflict because the U.S. suddenly has massive skin in the game. But there's a huge complication. China. Over 90% of the refinement capability for rare earths is controlled by China. So any joint venture would have to negotiate that bottleneck.
Okay, so we have this incredibly complex deal, all leveraging confiscated assets. So what does this aggressive move mean for the rest of the world? This is where that Pandora's box is wide open, right? If your nation's reserves, your U.S. treasuries can just be seized and used like this without your permission, what trust is left?
This is the critical juncture. This has changed everything. The confiscation doesn't just hurt Russia. It confirms for every nation in the global south, for the BRICS bloc, that they face massive counterparty risk.
Can you just break down what counterparty risk means for, say, a major central bank?
Sure. Think of it this way. When a country like Brazil holds U.S. treasuries, they trust the U.S. government will honor that debt. Counterparty risk means that trust is now conditional. If Brazil does something the U.S. dislikes, they now have a real-world example, this Russian seizure, that their assets could be frozen, or even worse, used against their will. It forces financial self-preservation, and that immediately drives the need to reduce your dollar exposure.
And we're seeing the evidence of that trust erosion in the data. Let's look at gold buying, central bank gold buying. Before the conflict, what were the numbers for unreported purchases?
Pre-war, unreported buying was negligible, maybe around 15 tons. Since the confiscation event, that unreported buying has surged. It's hit well over 200 tons per period.
That's a 14 times increase.
A 14-fold increase in the preference for physical gold over paper assets. It's stunning.
And this ties directly into the active dumping of U.S. treasuries, which has accelerated, especially since early 2025. What are the specific figures our sources are tracking?
Absolutely. The sight from dollar debt is real. India has dropped its holdings by $23 billion. Mainland China, they've reduced holdings by $60 billion. That number goes up to almost $80 billion when you factor in Hong Kong. And Brazil, a key BRICS country, is aggressively dumping its dollar bonds. These aren't minor shifts. These are strategic, coordinated financial moves.
So it's clear. While using these Russian reserves might be a short-term tactical win, it is simultaneously eroding the foundation of the global dollar system. And it seems the nation taking this risk most seriously is China.
China's strategy is unmistakable. They are pursuing what some are calling an economic divorce from the West. The goal is to remove themselves from U.S. financial hegemony. And they're using every lever they have, monetary, commercial, physical, to propagate the RMB and protect themselves from sanctions or swift exclusion.
And they're attacking this on two main fronts, right? Selling off dollar assets, which we just discussed, and promoting overseas RMB lending.
The shift in their commercial banks is key to this global push. Since 2020, Chinese banks have quadrupled their external RMB assets, loans, deposits, bond investments to nearly $500 billion. And critically, during this exact same period, their holdings of dollar assets have dropped. They're just issuing fewer dollar-denominated loans and buying less dollar debt.
Which makes perfect sense for the borrower, especially in emerging markets. U.S. loan rates are sitting above 4%, while Chinese loan rates are often below 1.5%. For any corporation, it's just logical to swap dollar loans for RMB borrowing, especially if their inputs are coming from China anyway. Yuan borrowing just works better.
But if we want to talk about the real final boss here, it isn't just the trade dollar, it's the euro-dollar market.
Okay, let's pause there, because that term sounds complicated, but it's central to the dollar's dominance. What exactly is the eurodollar market, and why is it the final boss?
Great point. It's a confusing name. The euro-dollar market has nothing to do with the euro currency. It's simply the vast global pool of U.S. dollars that are borrowed and lent outside the regulatory oversight of the U.S. Federal Reserve. And we estimate this system is currently a monstrous $76 trillion.
76 trillion, that's a staggering number.
It is, and this system drives global demand for the dollar even more than the petrodollar system. Global business just needs dollar credit to function.
So, if this eurodollar system is the source of global dollar credit, how is China even chipping away at a $76 trillion market?
Beijing is instructing its commercial banks to reduce dollar loans and aggressively offer those cheap RMB loans we mentioned. This isn't accidental. It's a direct, long-term move to de-dollarize global credit markets. They're replacing dollar-denominated credit with yuan-denominated credit. And if all your trade and borrowing are done in local currency, the threat of being kicked out of SWIFT becomes much less effective.
It's a titanic effort, as you said. It'll take decades, but the starting gun has clearly fired. And while they're deleveraging from the West financially, they're quietly building their foundation through gold.
Yes, this hidden accumulation is the ultimate hedge. We have reports from places like the Financial Times, corroborated by Goldman Sachs, suggesting the People's Bank of China has been systematically underreporting their gold purchases for decades.
How significant is the underreporting? Is there a clear example?
Yeah, they cited one instance where the PBOC publicly reported buying just 1.5 tons of gold in a single month. But the reality, tracked through refinery flows, indicated the real buying was closer to 15 tons.
That's a tenfold underreporting.
Exactly. So based on credible assumptions, China's real gold buying in 2025 is probably exceeding 240 tons, far more than they state. This massive, covert accumulation is the structural key to eventually replacing their dollar holdings.
So if we synthesize this entire picture, we see this really severe central tension. The peace plan and using the Russian assets are short-term tactical wins for the U.S. They get financial gain, a solution for rebuilding Ukraine. But at the same time, they're severely undermining the long-term integrity of the global dollar system by confirming that counterparty risk is real.
And that risk is the primary driver of China's aggressive financial deleveraging. Now, China still lacks the transaction dominance of the dollar, for sure, but their multi-pronged strategy, using cheap RMB loans to lure borrowers and massive hidden gold accumulation to secure their national wealth, it shows they are fundamentally building a parallel financial system. It's designed specifically to counter U.S. financial hegemony. The economic divorce is already underway.
We are witnessing nations actively choosing to replace the dollar with local currency loans and physical gold. If this trend continues, and trust in the integrity of Western asset holdings remains permanently fractured, what asset class truly becomes the safest haven in 5 years?
That is the essential question that I think financial leaders across the world are struggling with right now. It fundamentally changes how we view national wealth.
So how do you see it? Drop your thoughts in the comments, and if you haven't subscribed yet, join CredEdge so you don't miss the next insight.